Hey everybody, welcome back to Dividend Stockpile, where we talk about all things dividend investing and income investing related. Today's guest is Eric Lutton, Chief Investment Officer at Soung Income Strategies. Soung Income Strategies, as the name suggests, focuses on income investments. And the one we're going to talk about today is FXED, the Soung Enhanced Fixed Income ETF. Fixed income can be a great complement to our traditional equity investments and help smooth out the ride while providing steady income for your portfolio. So today we're going to discuss the details of this fund, its investment objectives, holdings, income characteristics, and how it could possibly fit into your portfolio. But before we get into all that, welcome, Eric. Thanks for joining us.
Thank you for having me, Jeremy.
Really looking forward to our conversation today. I was doing some research on this ETF, FXED, and I thought there's a lot of really great features that might be of interest to our viewers. And it's a little bit different than what we typically think of when we're talking about income investing and dividend investing. So we'd love to have you kind of give us a 30,000-foot view of what FXED does, and also a little bit about you and your company.
Sure. Well, I'll start off. I'll give a little background about Soung Income Strategies and my role here. So Soung Income Strategies was started by David Scranton. They filed paperwork back in 2014. The firm came into being in 2015. I joined David, and he had some advisors that were coming on board, and they were looking for definitely, like your show, an income niche. Most of the end clients were in retirement or close to retirement, and they were tired of the ups and downs and the volatility of the stock market. They were looking more for a solid, lower risk portfolio that was going to throw off monthly income, or at least quarterly. Mm-hmm. So when I started speaking with the guys, everybody wanted about 5%, and after fees, maybe gross around 6%. Well, naturally, I thought, hey, this is going to be, I've got to really go into a lot of high yield, but they didn't want really a risky high yield only type of portfolio. So that's where I was like, okay, we're going to have to go into some non-traditional fixed income or low correlated, assets that we're going to throw off some more income. Because if you remember in 2015, rates were near zero. So it was pretty rough looking at the time. But we also knew that rates were going to go up eventually. So that's going to hurt traditional fixed income with fixed coupons. So that's where we kind of mixed and matched things around. I kind of put in BDCs, business development companies, REITs. Obviously, REITs are going to help with rising interest rates a little bit if they have 2 or 3% increases in their lease agreement. And BDCs are floating rate loans, so that also helps. So we kind of developed just a kind of a non-traditional fixed income portfolio. As far as my background, I started off years ago on trading options on the floor of the Chicago Board Options Exchange. That was kind of the Wild West. Loved the job. It was exciting. It was fun. But then I started cutting my teeth in fixed income at a big insurance company on the wealth management side called Conseco Capital Management. So there we managed around $36 billion US, a lot of insurance company money, pension endowment funds, Taft-Hartley money. So it was very interesting, and tons of analysts and portfolio managers. So I learned a lot there. It was great, and ended up at an RIA and hedge fund and wealth management department and bank. And then a friend put me together with David because he wanted to start this RIA, and it was great. It was one of the few financial advisors I knew on the retail side that knew the importance of fixed income and generating monthly income. So it was refreshing to see somebody on the retail side that had that same point of view.
Yeah. That actually makes a lot of sense. You typically always consider investing being, S&P 500 or, very broad-based indexes. But to add in that fixed income, and in your fund's case, you're mixing it with some other type of investments to provide that consistent, steady income, but also have some upside, which you don't get for traditional bond investment. So I think that's a really interesting strategy, and I'm definitely looking forward to digging into it. You had mentioned that you guys offer, different types of holdings within the income strategy. Can you give a brief overview of what you're having right now and why maybe you chose that route?
Well, like I said, in 2015, we were at zero interest rates. So we knew rates were going to go up, and the current rates for investment grade bonds only, and even some quality high yield, the rates were very, very low. So I knew I had to put in some other asset classes. So basically, I was looking at the time when we were in zero interest rates, looking at BDCs, looking at REITs, looking at sovereign debt, and obviously trading sovereign debt $250,000 or $200,000 minimum for an account size to trade it. So that wasn't working for our smaller retail accounts. So we had to utilize some low-cost ETFs for sovereign debt. So mixing and matching all these asset classes was very important to get the yield up and to lower our, kind of try to look to lower our correlation, lower the risk, lower standard deviation, hopefully keep a lower max drawdown. So it was just a unique way of doing it. And then when we launched Fixed, we based it off our Core Plus strategy, which was the BDCs, REITs, sovereign debt, preferreds, and corporate bonds.
Mm-hmm.
So when we launched that, and because we had such a good success with Core Plus and our separately managed accounts, which we manage about $3.5 billion, it was just a way to mimic that and offer that out to the public because it was doing well. And when we launched at the end of 2020, so we've had 4 years, a little over 4 years now, track record. It seemed to be doing well. Decent standard deviation, decent return, and a nice monthly, bi-monthly dividend.
Yeah, that's actually one thing I was very interested to talk about is the bi-monthly distribution. You don't see a lot of investments offering to pay every 2 weeks or twice a month, as you mentioned. So I definitely want to talk about that in a second. But going back to asset allocation, it looks like right now, or at least the most recent information, you had BDCs, preferred securities, REITs, specialty investments, and U.S. corporate debt, as you had mentioned. So it's a good variety. So you're not just focused on traditional bonds. You do have some upside and some different, to your point, correlations on what's going to happen in the market. And as we've all seen over the last few months with all the volatility that we've seen in the market, there's something to be said about a very stable, reliable type of investment.
Yeah, I mean, I think investors, if they're taking a breather a little bit on the sidelines from this past 2 months, they could lock in some nice rates up here before the Fed does. And I think, they could, this late summer, early fall, they could cut, but I don't think they will until they start seeing inflation go down more. If that happens, they won't be too worried about pushing inflation back up by lowering rates or the cost of capital. So I think they will, by the end of the year, we may see a 25 to 50 basis point cut. Yeah. But, that's a very good point. What is this, how we're dealing with all this, a lot of funds have mandates that they have to be fully invested. So unfortunately, I can't go sit on the bench and cash your T-bills. We have to stay fully invested because investors are expecting that every 2 weeks, expecting that dividend to hit. So, even though we have to be invested, we're trying to pick quality companies that are going to continuously throw off that dividend interest income, even when we know markets are volatile and we know markets are going to contract a little bit. But if we can lock in some longer or higher rates for longer, that's going to work out well for the investors.
Yeah, definitely makes sense. Let's dig into some of the details of the fund itself.
Sure.
As you mentioned earlier, it started in 2020, end of the year. It does offer a semi-monthly distribution. From what I saw, the distribution is just under 7% right now. Obviously, that's variable.
Correct.
And you have, according to your website, about 52 holdings in the portfolio right now.
Yeah, 50 to 55. It varies depending on what's going on with markets. But yeah.
And can you give us an idea of maybe like the top 10 or different investments you guys have?
Sure. Well, it changes based on markets. Like we're big components. Like the breakdown would be, we have about 35, anywhere from 35 to 40% in corporate bonds. Another maybe 30%, give or take, in preferreds. So usually we try to stay 70, 75% in those fixed coupon type of securities. And then what I call the workhorses, the BDCs and the REITs. Those are going to be 15% to BDCs and 10% to real estate investment trusts. And so, at any given time, the BDCs make up a big portion. Individual bonds, depending on how much I'm buying, if we get a nice break and spreads widen in certain names where I think I can pick up a nice spread. I mean, we've been getting, I think, bond spreads the last couple months at 6.5%, and because we're real big fans of what I call crossover names. Maybe Moody's has an investment grade rating and we have a high yield rate, or S&P may have a high yield rating. So we call those crossover or split rated names, and we like those. But we're gonna keep zigging and zagging a little bit in the market. But overall, we're going to have about roughly 75% to fixed income, actual coupon fixed securities, and then the other 25% is going to be ones that we could see some capital appreciation and higher yields. Right now, we've got REITs in there paying, I want to say, anywhere from the mid fives up to 7. And BDCs, even though you can get BDCs, 11, 12% yields, we try to stay in the more conservative ones that have a lot of first lien debt. And so we're looking at 8, 9, 10% yields. So I'm willing to give up a little bit of yield there just to stay in safer names, so to speak. But it runs the gamut. I mean, those are the fields we kind of stay in.
Okay. And I think that's one of the main benefits about your ETF over, your traditional index variety bond funds like BND and AGG, and even the high yield ones like USHY, is because you do have that 25% allocation approximately to other names that can grow and increase the distributions, things like that, as opposed to the fixed income coupon where once you buy it, you know what you're getting.
Yeah.
And so that definitely gives you a little bit of a different take on a bond fund, but also gives you, potential for more upside.
Yeah, and that's kind of when we were back in 2015 when we were managing separately managed accounts, and we were developing these strategies. That's really what we were after because, like I said, rates were low, and we knew rates were going to go up. So that was going to also we'd lock in low yields and then get punished for locking in low yields in the future. And that's what led to this, because the funds you mentioned, basically the ag and
BND, which is
BND, those are more ag related, so in the ag's like 43% to treasuries and agency mortgage backed securities, lower risk, but also lower return. So we feel if we could add those non-correlated or low correlated assets that were paying much higher coupon interest, that's where we could get the boost. Just adding high yield, because the ag doesn't have high yield, just adding high yield helps. But if you go into pure like US high yield, USHY, that's 100% high yield. So they're going to have a lot of single B and a lot of C rated credits, which we're not, I'm not allowed to put those in our fund, even if I think it's a great credit and going to pay off. So we're trying to get a lower standard deviation that. But I think we've even beaten that high yield fund up until I think recently in the last month and a half, 2 months with this tariff volatility. So over the past 4 years, we've even beat most of the high yield funds out there. And like I said, we're just under 7%, like 6, 9 and change on yield. And I think a lot of those high yield funds pay a little bit lower than that. I'm not sure what US high yield's paying. I think it's 6.5, 6.7, somewhere in that area. But I think over time, right now it's a flight to quality. They've sold off their equities. They've gone into treasuries, agency, and benchmark type of fixed income securities. But once it goes to the risk back on, that's when you'll see actively managed funds like ours, if they're doing what they're supposed to be doing, start to outperform again. Yeah,
that makes a lot of sense because you guys are actively looking at what makes sense as opposed to having to do, the whole broad market like BND and AGG does. And I think, the fact that you can pick and choose instruments outside of the high yield bonds that USHY does, it gives you that perfect balance between, getting a higher yield, but also having the quality of, a broad bond fund. So I think it's great that, this particular strategy has, beat out BND and AGG over the long run. And it's kind of neck and neck with USHY depending on, the timing. But to your point, until like March of this year, you guys were beating even the high yield bonds. So that's a really good approach. Again, it's for someone who wants some more stability in their portfolio, wants more of a fixed income that they can rely on. It's not going to replace an equity position, but it's a good complement to kind of smooth out your ride a little bit more. And so I was looking at your fund, and it has over $40 million worth of assets. So that's a pretty decent sized fund, given the focus of the last couple of years of high tech and equity investing. To have $40 million in the fund is pretty strong. So we. Of course, our principal would like to see it double or triple from there, but maybe in time. And that's why I love highlighting certain ETFs out there. And I tend to focus on the ones that are maybe not as well known, that offer a unique product, a unique service, something you can get outside of just picking one of the very broad-based ETFs that you have out there. So I love the fact that you were able to come on and talk about this product. If you can give someone like an elevator speech on FXED and what benefits it could do, what would you say?
Sure. Well, I think fixed, like you would point out, fixed is unique. A lot of managers will pick high yield only or investment grade only or a sovereign debt only fund. Well, we're unique because we're not trying to be the best high yield fund or the best sovereign debt fund. We're trying to be unique and incorporate all that diversification already in there. Like I tell people all the time, you could go to the store and buy all these ingredients and then go home and bake a cake, or you can just go to the baker's and have a great cake already made for you. It just depends on what that individual investor or manager is looking for. We're trying to do all the work here so we can give a high yield type of return, but not take on that much standard deviation or that much risk.
And that's one thing I've been telling everyone is, like, having an active manager that's dedicated to this work, that's doing the research, that has the team behind them, that understands how these bonds or fixed income and investments work. That's more than what we would want to do as individual investors. Even if we have the knowledge, that still takes a lot of time and effort. So to pay a professional that you guys are watching this on a day-to-day basis, you're watching what's happening in the market, you understand what is a good yield and not a good yield, or risk or not a risk. For us individual investors, most of us don't have a lot of bond training, if you will. Yeah. So using an active manager to select the holdings for you and the strategy makes a lot of sense to me.
I agree. It's you don't even find a lot of what I call retail financial advisors, because it's a lot of hard work dealing with fixed income, going through the Ks, the Qs, talking to management on calls. It's a lot of work, and you don't, if your yield's 5.5%, they're busy trying to find the next NVIDIAs of the world and hoping they're making 20, 30, 40, 50% returns one year, and hopefully they don't lose it. But with fixed income, once people are in retirement, they're like, hey, I just want to pull out X dollars a month and not touch my principal and sleep at night. So there's a lot of investors out there that this product, is for them.
Yeah, it totally makes sense. As I mentioned off camera, I'm an income investor, so my primary focus is that income that comes in. Because as everyone says, capital appreciation can't pay your bills. Yeah. You end up having to sell off the shares in order to do it, and that's not what my style is. I want to be able to keep my principal there so I can pass it on to my kids or charities or whatever it happens to be, and live off either the dividend or the interest income that comes in. Yeah. So it doesn't matter if the stock goes up 50% a year, as long as my income, or goes down 50% a year, as long as my income is steady and over time the capital appreciation at least keeps up with inflation, I'm happy with that. Yeah. And so you have to understand what your goals are and what your expectations are for your investments to determine, is investing in the Mag 7 the way to go, and hopefully you do well and you take that risk that you won't, or you go with a more of a sure thing, a steady riser over time.
And I tell people, I said, if you want to have 5-10% of your portfolio because you just are upset the Mag 7's up, 30-40%, fine, let's take 5%, invest in something like that. But the bulk of your assets, if you're looking for steady income, there should be a lot of fixed income. And it's unfortunate because the industry was always, Wall Street from the 80s and 90s on, has been so equity focused. I mean, you had news channels that were focused mostly on equities, where in big institutions, I came from the institutional side, we were focused on fixed income because you're dealing with tens of billions or hundreds of billions of dollars. It's a big market. And I always tell people, I said, look, the S&P has averaged, since World War II, a little over 10%. And there's a lot of volatility to get that 10%, where fixed income's average about 5.5%. So I'm like, if you think you can earn 6-7% and have more fixed income type of risk or standard deviation, you're better in locking that in than trying to guess the perfect time to buy and sell your equity portfolio all the time. Yeah, that becomes tiresome.
Yeah, it's the whole sequence of return risk too. If you're approaching retirement, you're going to be needing to sell off your equities. And if we have another 20%, 30%, even 50% downturn like we did in the Great Recession, that's going to really hurt your future returns and your future ability to fund your lifestyle. Yep. But again, if you're just worrying about the income that your portfolio produces, you can ride it out and just rely on the income. So I think it's definitely wise for people to consider fixed income. To your point, a small sliver of your allocation can probably go into something like this. I wouldn't recommend it 100%, but it definitely can, complement your equity portfolio, especially if you're more of a conservative investor or someone who's going to be needing to use income in the next few years. I think that makes a lot of sense. Before we go, where can people find more information?
You can always Google us. We're on the internet, but they can reach out to Sound Income Strategies, and we have financial advisors across over 100 plus financial advisors across the country now. So.
That's awesome. All right, so I'll put your website and all your contact information up on the screen after we're done. But everyone take a look at their fund, see if it fits your profile, see if it fits your risk, and definitely give them a consideration. And again, if you have more questions, you can always reach out directly to them. I'm sure they'd be happy to answer your questions. All right, Eric, thanks again. Appreciate
Thanks
your
for
time.
having me.
Have a
Thank
great
you.
one. Thank you.
Bye-bye.